Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. Capital structure theory. Capital structure theory, this is our today's topic. Actually, capital structure theory deals with the relationship between a company's capital structure and its total market value. So we will see that this capital structure theory actually related to the total market value of the share of the company. Total market value of the company. We assume that maximizing a company's total market value is consistent with maximizing the market value of its ordinary share. We assume that the maximizing a company's total market value is consistent with the maximizing the market value of its ordinary share. Traditionally, it has been assumed that there is an optimal capital structure for a company. Optimal capital structure of a company. Optimal capital structure is that ratio of debt and equity that maximizes the firm's total market value and minimizes its cost of capital. So there has the optimal capital structure theory. Optimal capital structure. Optimal capital structure actually is that point. It shows the ratio of debt and equity. Debt and equity, or equity and debt, in a way that maximize the total firm value, maximize total firm value and minimize its cost of capital. So optimal capital structure is that ratio of debt and equity which shows maximize the firm value and minimize its cost of capital. Actually, is there any optimal capital structure? Is there any optimal capital structure? There are three views on these important questions have been proposed and debated. So here we will see traditional view, view with no tax, and view with tax. So is there any optimal capital structure? To answer this question, there are three views which are proposed and debated. That means we have three capital structure theory. One is traditional view, another is view with no tax, after that the MM with income tax or tax. MM with no tax. MM means Modigliani and Miller. In 1958, Modigliani and Miller suggest that in absence of tax, the total market value of a company is independent of its capital structure, and as a consequence, the weighted average cost of capital of a company is also independent of its capital structure. So in 1958, Modigliani and Miller has suggested that in the absence of tax, the capital structure are independent, and as well as weighted average cost of capital also independent of its capital structure. So for these reasons, this theory has several assumptions. Number one, there is a perfectly positive capital market. Number two, all the companies can be divided into homogeneous risk classes in which the business risk of all the companies in a particular risk class is the same. That means homogeneous risk classes. Number three, there is no personal or company income tax, no tax. Number four, debt is risk free. So these are the assumptions, and the companies and individuals can therefore borrow at the same rate of interest. Company and individuals can borrow the same rate of interest, and there is no bankruptcy cost. Number five, there is no bankruptcy cost. These are the five assumptions of this theory, MM view with no tax, Modigliani and Miller. So on the basis of these assumptions, we will see the total market value of a company and its cost of capital are independent of its capital structure. We know that the market value of a company and cost of capital are independent, so company's total market value can be calculated as V equal to total market value of the company, NOI, that means net operating income, divided by K, that means a discount rate. So in by the use of this formula, we can find out the value of the firm. Number two, the required rate of return of a company's equity, KE, is equal to the required rate of return when the company is totally equity financed. So whenever the company is equity financed, then the cost of equity and required rate of return are same. That means KE, cost of equity, and required rate of return are same. So here we will see K star plus an increment of financial risks plus an increment of financial risk. That means we can call it the risk premium. That means it should be in this form. This increment is equal to the difference between the required rate of return on the pure equity stream, K star, and the required rate of return on debt, KD, multiplied by the debt equity ratio. So here we will see KE, cost of equity, equal to K star plus K minus KD divided into D, that means value of debt divided by value of equity, debt equity ratio. So it will in this form K star plus risk premium, Therefore, as a company increases the portion of debt in its capital structure, the cost of equity increases so as to exact offset any disadvantage from using debt. And the number three we will see investment is financed, that means totally brought. There is consistent with the irrelevance of financial decisions and indicates that it is only the investment decisions that is important in the pursuit of the objective of maximizing the market value of the company. An important conclusion is that the following of the proportion of the financial manager does not need to know how a project is to be financed when estimating its required rate of return. So MMP will show a graph, that is KD, and that is K, and that is KE. So that is the view of MMP in this form, MMP with no tax. So K will remain the same because the required rate of return on equity increases, as which is the rate of using debt, so as to offset exactly benefits of using cheaper debt funds, and K is unaffected by the changing the capital structure. That means if this K cannot be changed by the change of capital structure. Here is the debt equity ratio, and here is the required rate of return in this sense. Here we will see an example to understand the MMP with no tax. Here is the two companies, one is levered companies, another is unlevered companies. Unlevered companies means which are the 100% equity financed, and levered company which is has a debt on its capital structure. So assume that a company has all equity capital structure comprising 1 lakh shares issued at 50 cents each, that means 50,000 its capital. It expected to earn a constant annual net operating income of 10,000, which is to be distributed as dividends. The rate of return required by the company shareholders at 13%, and we shall assume that the present situation has no taxes. Now assume that another company which is issuing 60,000 shares and 50 cents is, that means 30,000 equity shares and 20,000 broad fund, that means 20,000 of 8% debenture. It also assumes that the market value of debt remains equal to the issue prices, and the company's shareholders have a required rate of return of 14%. So here we see that it has the 50,000 its all are equity capital, 50,000 is its capital, equity capital, and it has the 60,000 share, 50 cents is, that means its price is 30,000. 30,000, and 20,000 it's broad fund. 20,000 it's broad fund. Total 50,000 of its capital. So that is the equity, that is debt, and it is totally equity financed company. These are the two companies. Now we will try to see the firm value of these companies and weighted average cost of capital. We know that these two companies are homogeneous risk classes, that means identical. Its annual income is 10,000. One is levered, another is unlevered. Which is used debt, another is used no debt. First we will try to calculate no debt companies. Interest on debt, it has 0, that means no debt. Income available to shareholders, that can be calculated in this way: net operating income minus interest on debt, that means 10,000 available income to the shareholders. Then cost of equity of this unlevered firm is 13%, that means 0.13. So market value of the shares are that will be calculated in this way, equal to income available to shareholders divided by cost of equity, that means 76,923.08 taka. Market value of debt obviously 0, that means this firm has no debt. Then what will happen to its total market value? So total market value can be calculated, the market value of shares plus market value of debt, that means 76,923.08 taka in its market value. So now we will try to see the levered companies. So its income is also the 10,000, but it has interest. It takes 20,000 taka debt, that means the debenture 20,000 into rate of interest 8%, that means 0.08. that means it takes 1,600 taka as a interest. So income available to shareholders is can be calculated net operating income minus interest on debt, 8,400 taka. So we know that these companies cost of equity is greater than the unlevered companies, because it has debt on its capital structure. That's why the shareholders earn required rate of return more than the unlevered companies. So market value of the shares are income available to shareholders divided by cost of equity 60,000 taka, and market value of debt is 20,000. So what will happen? The total market value 60,000 plus 20,000, so 80,000 is its market value. So we are saying that the levered companies market value is greater than the unlevered companies with the having 20,000 taka debt in its capital structure. Now we will try to see the weighted average cost of capital of these two companies. So we know that unlevered company issue 1 lakh shares and levered company issue 60,000 shares. So the share price should be of these two companies are, there is the market value of shares divided by number of outstanding shares. So that means 77 cents its market price of share price. $0.77. And now we will see the levered company's share price equal to market value of shares divided by number of outstanding shares, that means $1. So it is clear that the unlevered company's share price is 77 cents, whereas levered company's share is $1. Now what about our cost of capital, weighted average cost of capital? That should be the 13 for the levered companies, unlevered companies 13, that is KE means cost of equity. Here is the cost of equity divided into market value of shares divided by total market value, that is 13 is our unlevered companies cost of equity, whereas the levered companies cost of equity is 0.125. that means here is the cost of equity 14% divided by 60,000 divided by 80,000 plus KD 8, 0.08, 1 minus T, that means tax rate is 0, D, debt value of debt 20,000 divided by value of market value of shares, or total market value is 80,000. So in this way we have seen that the cost of weighted average cost of capital is 12.5. So in this case we will see in this case the levered company has a higher total market value than the unlevered company. By means of arbitrage process, an investor can take advantage of these situations by selling the shares in the levered company and borrow on his personal account and investing the combined account in the shares of unlevered company. For an example, consider an investor who wants $3,000 worth of shares in the levered company. 3,000 worth of shares of levered companies. So, recognizing that the levered company is overvalued, he could sell his shares for 3,000. To replicate the leverage of a company, 20,000 divided by 60,000, he could borrow 1 thousand on his personal account. Given the assumption interest rate on the borrowing is 8%, the shareholder can now use the proceeds of sale of shares plus borrowing to purchase the 4,000 worth of shares in the unlevered companies. So here as we say that 3,000 worth of levered companies he can sell his shares and can earn $3,000 and can borrow on his personal account 1,000 taka borrow. That means total amount is 4,000, and this 4,000 can be invested in unlevered company. Originally, shareholders' return on his investment in the levered company was 14% of 3,000, that is 420. He expects to receive from his investment in the unlevered company 13% of 4,000, that means 520. However, from this must he deducted the interest charges 8% of 1,080. Share is therefore able to increase its total return by 20 without change his exposure of risks. A large number of shareholders will take a similar courses of action. This will drive down the price of levered companies' shares and force up the price of the unlevered companies' shares until there is no further opportunity for gain. The total market value and weighted average cost of capital of two companies will be the same. As a result, the company is unable to increase the total market value by introducing debt to in its capital structure. In the other word, if a company finances its expectation with what seems to be cheaper debt, the weighted average cost of capital will remain the same because the required rate of return on equity will increase by an amount so as to offset exactly the benefits of the using cheaper debt funds. Therefore, financing decision is irrelevant to achieving the objective of maximizing the shareholders' wealth. So, and the MMP will discuss that the financing decision is irrelevant to achieve the objective of maximizing the shareholders' wealth. This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.